If you're at a 75% expense ratio and you can get it down 5% or 10%, then you really start making money.
Yeah. And then that goes with the whole operations. It's like when you're buying this, you're not just buying a building and putting people in. You're buying the whole business. You're buying the business of having the doctors, the skilled nursing staff, the unskilled staff who are like the orderlies who go and clean up the messes and stuff like that. You're buying the cafeteria staff, the whole food service as well.
Welcome to the Ironclad Underwriting Podcast, where precision meets performance in commercial real estate. I'm your host, Jason Williams, and every week we deep dive into the strategies and systems and stories behind rock-solid underwriting. Whether you're a seasoned analyst, an up-and-coming investor, or a commercial real estate professional looking to sharpen your edge, this show is your front row seat to expert insights, emerging trends, and real-world underwriting tactics that stand the test of time and scrutiny. From market assumptions to debt structuring, cap rates to cash flow, we're cutting through the noise and getting to the numbers that matter. So sharpen your pencils and fire up those models. Let's get to work. This is Ironclad Underwriting.
Hey, everybody, welcome to this episode of the Ironclad Underwriting Podcast. I'm your host, Jason Williams, and I got my good friend and co-host, Frank Paatalano, here with me today. How are you doing, Frank?
Hello, sir. Trying to plan the next time I'm going to come down and see you, actually, right now.
Yeah, you said it's going to be, what, in a month or so when you're coming back down this
Working
way?
on it, looking at different flights and options.
So, well, let me know, and I'll clear my schedule for you.
Thank you.
To continue our series on senior housing, we talked with Rod Khalif a couple episodes ago, and then last one we kind of went more in depth into like what senior housing are and the different levels you can work with. And now we're going to go into how do you obtain one? How do you buy one? And so, you ready to get started?
Absolutely.
So when we were talking with Rod, he was saying that to build one, you're looking at what, 250K to 350K per unit to build one. And to buy one, it could be significantly cheaper. But he never really got into the like how long it takes to build one versus buying one. He just said to build it from scratch, you're going to be looking at 250, 350. But doing some research, I found the average time to build one is about 2.5 years. So like right at 30 months. So if you don't have that kind of time and that kind of investment, and if you're using investors, not going to be able to pay returns for at least 2.5 years, buying is probably a better way to go. What do you think?
Yeah, I mean, I have at least a dozen friends that are in this space, and out of 12 people, I think one is building new, and the rest are seeking to purchase existing.
So, and these are like buying actual senior housing and not buying something and converting it. So,
Correct.
um,
So I
and
have had a
so
couple of people looking at office conversions to senior housing, which is interesting.
that is interesting because we also talked about what it takes to convert something, and like the higher up the ladder you go, the more care you need for your residents, like the more security you need as well. So you can't just have like an open apartment complex type setting where people can come in and go as they please. You have to have like a single point of entry so that they can go in and out with like, I guess, permission. A lot of these people, especially in the memory care, they don't really know what they're doing. They don't know what decade it is. And so they're like, all right, I need to go get some milk. So I'm going to go walk down to the grocery store, and they don't even know. And if you're like in an open apartment atmosphere, what's to stop them from just walking off and never coming back? So you have to have like either like totally enclosed area or at minimum like have everything gated off. But even then, you don't want people going out in their robe and slippers trying to buy milk when it's 29 degrees outside. So
Yeah.
converting something is going to be difficult. Converting like office space, which everything is usually internal, you have like hallways and you can break off into rooms and stuff like that. It is a little bit more doable. So, and another thing is, I know Rod said that he only buys and uses like the self pay option. He doesn't do insurance or anything like that. And so that is another thing. Is like if you're buying and you're going to plan on using like Medicare, Medicaid, and insurance, it's like what hoops do you have to jump through to make sure that what you're buying is up to standard versus what you build? And so that's just another hoop you have to jump through. I was just throwing that out there.
Yeah, like you said, 29 months, 2.5 years, the amount of time it takes to build brand new, and there's definitely a big demand for it now, depending on the market. And like I think you said, it because it takes so long to build. What's interesting to me is how the building is not being built that fast in some areas. Building is way down in some markets.
Yeah.
Probably because the cost has gone up so much.
Yeah, and permits and approvals from the city. Hell, we're working on a construction. We're what 18 months into it. We haven't even broke ground yet because of permitting and dealing with the city. We're not even inside city limits, and I can't imagine what it'd be like inside a city, especially one that's not really friendly in that regard. So,
Right.
but the market you're wanting to buy in, you have a lot of things going for you. You have the baby boomers are becoming that age where they need to start moving into these types of facilities. And then that goes back to what Rod Cleef was saying. It's like he does the self pay model, which I just mentioned. So he gave out a big old number, which I don't remember what it was. How many baby boomers are going into these facilities every day?
Did he say 10,000 a day?
It was something like that. So if you're doing a self pay model, I think you're probably only going to get a fraction of that because I know there's a lot of wealth in the baby boomer generation, but not all of them have the wealth to be able to pay for this type of care.
Yeah,
I
I think
was,
you used the word private pay a lot. And there's if you even think about the 80-20 rule or the 90-10 rule, so if 10,000 a day across the country, and if it's 10%, that's 1,000 a day that
yeah,
would even be eligible for his type of property.
yeah. I was talking with someone the other day about um, her parents being put into a home like this, and she ended up saying it was going to be like 40,000 a month for her mom.
Oh, that's very high end. If it's and by the way, obviously it depends on which market and stuff like that. But I mean, when we priced it out at like 12,000 a month.
But again, it depends on whatever level care.
Yeah, yeah. No, I understand that.
So for like skilled nursing care, you might be looking at that where you have to have a nurse, single nurse on call for that one person and everything. So, but yeah, so I think having, and I'm just throwing this out there. I again, I don't do this yet. I'm probably gonna end up developing like some sort of not necessarily senior housing, but assisted living because my son is special needs and he's going to be at that age where he can be in like we want him, and this might sound like selfish and crass, but out of the house living on his own, but he can't live on his own without some sort of support and care. So there's what I'm thinking about. But if you're going to do this and you are going to do the Medicaid, Medicare, and insurance route, which sometimes it will pay for at least a portion of it, just do your research and figure out what it takes to do to jump through those hoops.
So right now we have a high demand, and like most of the articles I'm reading, there's definitely supply issues in different markets. I mean, even my local market, I'm thinking of the number of vacant ones post COVID, the places that the business itself could not survive, and it's been vacant for years. And now, what are they doing with it? One of them they turn into apartments, but it's like we kind of need the housing. I looked at one at one point, and I was going to convert it the opposite way. I was going to convert it from senior living to offices, but the city didn't like it, so I moved on.
Yeah. Yeah, and going back to the pricing, he Rod was saying for building new is 250 to 350K per unit. I don't know if he ever gave us a unit price for buying one though. Do you remember if he did?
Um, I don't remember if he did, but I mean, in different markets, I've seen it. I've seen much less than that. I've seen, it depends on the market, obviously. I've seen 50,000 a door or a unit.
So, and that I think would be actually pretty cheap because I mean we're buying apartments at what 70K to 150K per unit, so I would expect
Yep.
at least that, maybe more. But he's also saying that the returns he gets on these is like super incredible. So, do you know what kind of cap rate he's buying at to get this, or?
I don't remember the cap rate, but don't forget there's a lot more expenses.
Yeah,
So the
I know,
expense
but
ratio is much higher, 75%, 80%.
so I'm trying to think of how you have like a higher expense ratio, but your returns are like so much better than multifamily as well. You know what I'm saying?
Yep.
Because if I'm thinking about like a multifamily and I have an expense ratio of 75%, my returns are going to be dismal. So,
Say
but
that
maybe
again?
that if I have an expense ratio of 75% in multifamily, the returns are going to be dismal unless there's like a huge back end.
So I'll question you on that. If you have provable expense ratio of say 75%,
Mhm.
and you're buying at the same cap rate, say you're buying at a 7 cap, if it's just based on the cap rate, it sounds like you'd be around, you won't be the same price, but you'd still be in the same position because your cap rate's the same. And then if you're at a 75% expense ratio and you can get it down 5% or 10%, then you really start making money.
Yeah. And then that goes with the whole operations. It's like when you're buying this, you're not just buying a building and putting people in. You're buying the whole business. You're buying the business of having the doctors, the skilled nursing staff, the unskilled staff who are like the orderlies who go and clean up the messes and stuff like that. You're buying the cafeteria staff, the whole food service as well. So I understand like the high expense ratio. I'm just trying to crunch numbers in my head to make it make sense.
Well, I mean, in some ways, it's like hospitality in the fact that, especially depending on what level of service, you need to be able to provide service and care almost 24/7.
Yeah. So I'm just thinking if you're at 70% and you get $1 million a year, your expenses are 700K. That means your NOI is going to be what, 300K
Yep.
roughly. So 300,000 at a 7 cap, you're looking at like $4.3 million property. Let's see if we get that down to 65%. Yeah, you just increased it almost 800, 715K, going from a 70 to a 65% expense ratio. And I'm just saying $1 million is easy numbers. I expect that to be a whole lot higher per year, depending on the size, of course. So,
Yeah.
and again, this is buying the building and running the business versus just buying the building and triple netting the business to somebody else. So, because that could be another play. It's like you have the building, you have the facility, and all you do is take a triple net lease and you really share no upside then in that regard. You just rent out the building, the four walls. So you also need to figure out your due diligence. And while I have a due diligence checklist for commercial like multifamily, I do not have one for senior housing,
Yeah.
but yet look for it on my website in my vaults. I will get one out as soon as I can. Maybe after Rod does one of his boot camps on senior housing, I'll be able to update some of our numbers or some of our resources. But
So I
some
mean,
things
good.
go on. No, you go on.
I mean, back to the concept. When you're buying one of these, you're looking at, like you said, the cap rate. You're double checking the price per unit, and you're looking at the business itself and how much the business is earning. So it's a three-part thing to review the numbers here.
Yeah. And you're gonna need to, when you're doing your due diligence, you need to check for all the hidden problems. CCRC, you know what that stands for right offhand? I do not. I will
I
get that in
forget.
the show notes. Um, but residents with big refundable entrance fees. So a lot of times, whenever a new resident signs up and moves into your facility, they get charged huge upfront fees, and some of those are going to be end up being refundable. So
Continuing care retirement community.
there you go. If they leave or they move to a different facility, they're going to need some of their money back from that deposit, refundable deposit. So
Sometimes what happens, depending on the level of care, and depending on what level of care you have in the facility, I've seen people get hurt, get sick, get hospitalized, so they're gone for a little bit, and then they have to, and then they're coming back. So it's interesting. I don't know enough about the business model itself. I'm still learning, but it's interesting. Are you holding a bed for them, especially these places that are full? Do you give a discounted rate because they're not eating there and stuff like that, but you still have to hold the bed so nobody else can use it?
yeah, and remember, Rod was saying a lot of the services are a la carte. So if you a la carte everything, you can keep the bed in their name, keep the room in their name, but then you can take off the food service, you can take off the nursing care and or the person who checks up on them. And so yeah, you might not make as much money, but it's they're still paying for that room and that bed so that they can come back. Sometimes. That's how I
Yeah.
would imagine it, but again, I don't know anybody other than Rod who's done this. So
So, so we should just go out there, Jason, and buy a cheap building and make this happen, or what? You want to
yeah,
manage it? We'll find one down the street from you.
yeah, that sounds good. Let's go jump in. I think there's a building down the street we can buy. So this is interesting. New construction is 77% down from recent peak. So inventory growth is at a record low right now. So there are going to be a lot of builders coming up soon, I think. But again, 2.5 years to do it. So they won't, if they start now, they're not opening until 2029
Nine.
now. Because right now, this is currently the summer of 2026. So beginning of 29. Um, Good stabilized buildings are probably going to be in the low to mid 5% cap rates. Institutional price per unit, again, 250 to 350K per Rockleaf, and it could be lower if you're just doing a lower level of care, or higher if you're doing a higher level of care. And coverage targets. So you're looking at, this is almost like your debt service coverage ratio. You're looking at a 1.0 to 1.2.
Sounds a little thin and tight to me, by the way.
Yeah, and if it gets down below 1, you're coming out of pocket for your own things. You better have some reserve. So
I mean, I haven't looked at that many deals, but what I have seen on a lot of deals is that the increases have not reflected inflation, etc. So there are some places where the monthly rate is only 3,000, but the local standard rate might be 5. So those are the reasons why you'd have room to raise prices.
but you also have to keep in mind that your entire resident base is going to be on a fixed income.
I agree. I'm not saying I agree 100% with that too.
And And I say that, like I said, a lot of them might have some money tied up, that the retirement that they can tap into. But for like Social Security, that's where the fixed income comes in. So they get so much money from Social Security, and a lot of times I think they just end up signing it over so that the facility gets the checks instead of it going into their account. But I don't know all the nuances in that. And as an owner, I don't really need to, so long as the operator who's running it knows what to do. So
Yeah. I mean, I'm not an expert on either, but I've also heard people get reverse mortgages on their personal residence. And then eventually, after so many, I don't know what the time frame is, their kids live there and they move into the facility.
yeah. So just go find a cheap building and convert it. Sounds like a winner. With
That's
10,000
sarcasm.
with 10,000 people, would you say a year or a month or whatever? A day coming in, that's going to be a huge wave. You ride that forever. And then the full building is a safe building, so you better make sure that it meets all the standards that you're trying to do for senior housing. So if you want to know more, I will have more in the show notes. I will have more senior housing in my vault on my website, ironcladunderwriting.com. And we'll catch you next time. Bye.
And that's a wrap for this episode of the Ironclad Underwriting Podcast. If you got value from today's conversation, make sure to subscribe, rate, and share the show. And don't forget to connect with us on LinkedIn, YouTube, Facebook, Instagram, or check us out at our website at ironcladunderwriting.com for more insights and updates. If you have a question, a deal you're analyzing, or a topic you want us to tackle, shoot us a message. We'd love to hear from you. Until next time, keep your assumptions grounded, your models sharp, and your underwriting ironclad.